Stop doing what you're doing and listen to this. I bet you didn't know how much $1 million is worth today. In the past, having $1 million was considered a symbol of immense wealth. For many, $1 million was the ultimate financial goal, a benchmark that represented financial freedom and stability. However, the financial landscape has changed drastically over the past few decades. While $1 million was once a significant amount of money, its purchasing power has been eroded over time due to inflation and changing economic conditions. In today's world, $1 million doesn't stretch as far as it used to, and for many people, it may no longer be enough to live a lavish lifestyle or ensure financial independence. In fact, many people would be surprised to learn that being a millionaire today doesn't necessarily mean you're rich by traditional standards. It's a significant sum of money, no doubt. But the real question is, how much cash flow does $1 million actually generate when invested? Will it be enough to support a comfortable retirement? And most importantly, what kind of lifestyle can you expect if you rely on this nest egg? In this video, we'll explore what $1 million can realistically provide in terms of income, how much you can safely withdraw each year during retirement, and whether it will truly allow you to live the posh lifestyle that many associate with millionaires. How much income does $1 million generate? It's easy to look at the yearly returns of a portfolio and assume that you can safely withdraw those gains during retirement. For example, if you have $1 million invested and the portfolio generates a 12% return in 1 year, that's $120,000 in gains. It might seem tempting to withdraw that entire amount and use it for living expenses. In the following year, the market might return 8%, giving you $80,000 to withdraw. This approach might work in some years, but the problem is that the stock market's returns can vary dramatically from year to year. For instance, in 2018, the S&P 500 returned a disappointing negative 6%, which means you'd face a $60,000 loss instead of a gain. Clearly, this wouldn't leave much room for spending, and you might even find yourself dipping into the principal of your portfolio to cover expenses. Then, in 2019, the S&P 500 bounced back with an impressive 29% return, making it a profitable year for investors. But this example illustrates the inherent volatility of the stock market and the uncertainty that comes with relying solely on market returns for income. The risk of market fluctuations means that using yearly gains as your sole strategy for withdrawals isn't a reliable or sustainable option. The impact of inflation on your $1 million. Another major factor to consider is inflation. Even though $1 million might seem like a lot of money today, inflation steadily erodes the value of that money over time. On average, the stock market returns about 10% per year, which might make it seem like your portfolio will generate $100,000 in annual income, a healthy sum for the first year of retirement. However, fast forward 30 years, and the purchasing power of that $1 million will have diminished significantly, even if your portfolio still generates $100,000 per year in returns. Assuming an average inflation rate of 3%, the value of your money would be cut in half in just 24 years. That $100,000 in returns won't buy nearly as much in the future as it does today. This is why it's important to account for inflation when planning for retirement. The cost of living will rise over time, and you'll need to adjust your withdrawal rate accordingly to ensure that you maintain the same standard of living throughout your retirement years. How much can you safely withdraw from a $1 million portfolio without running out of money? Given the unpredictability of the stock market and the impact of inflation, this is a crucial question. There are varying opinions on this, but most financial experts recommend following a safe withdrawal rate to ensure that your portfolio lasts throughout your retirement. Some people suggest withdrawing only 3% per year due to the uncertainty of market returns. Others advocate for a 5% withdrawal rate, citing the fact that there hasn't been an extended bear market in recent history. However, the 4% rule is widely accepted as a safe and reliable withdrawal rate for retirees. The 4% rule means that during your first year of retirement, you can withdraw 4% of your portfolio, $40,000 from a $1 million portfolio. After that, you can adjust for inflation. For example, if the cost of living rises by 3% in the first year, you'd withdraw $41,200 in the second year, and so on. This rule is based on several key factors. Portfolio composition. The 4% rule assumes that your portfolio is made up of 50% stocks and 50% bonds, which is a fairly conservative allocation. Some investors prefer a higher stock allocation for potentially greater returns, while others, like Dave Ramsey, recommend 100% stock investments for long-term growth. Ramsey argues that bonds are risky in their own way due to their lower returns. However, most experts advise increasing bond exposure and reducing stock exposure as you age to lower your overall risk. Retirement duration. The 4% rule is designed for a 30-year retirement period. If you plan to retire early, in your 30s or 40s, a 4% withdrawal rate might be too high, as your retirement could last more than 30 years. In that case, withdrawing at a lower rate, such as 3%, might be more sustainable. What happens if you live longer? One of the biggest challenges of planning for retirement is that you don't know how long you're going to live. If you knew the exact date of your death, it would be much easier to budget your money and determine exactly how much you could safely spend each year. However, since we can't predict the future, it's essential to be conservative in your planning. The Social Security Administration estimates that the average remaining life expectancy for a 65-year-old is around 20 years. However, this is just an average, and many people live much longer. Advances in healthcare and increased life expectancy mean that you could potentially live well into your 90s or beyond, especially if you're in good health. If you plan for a 30-year retirement but end up living longer, you risk running out of money if you're not careful. This is why some financial planners recommend using even more conservative withdrawal rates or considering longevity insurance to protect against the risk of outliving your savings. What about Social Security? Social Security benefits can play an important role in supplementing your retirement income. The amount you receive from Social Security will depend on when you start taking benefits, how long you contributed to the program, and your taxable income over the years. If you start taking benefits at age 62, you'll receive a lower monthly payout than if you wait until full retirement age, which is around 66 or 67, depending on when you were born, or age 70. The average Social Security benefit is about $18,000 per year, but it can vary widely depending on your specific situation. If you combine Social Security with your 4% withdrawal from a $1 million portfolio, your total annual income would be around $58,000. For a married couple, that amount could double to $76,000 per year if both spouses receive Social Security benefits. While $58,000 to $76,000 per year might be a livable amount for many retirees, keep in mind that taxes will also affect your net income. The tax factor. Taxes are another important consideration when planning for retirement. How much you'll owe in taxes depends on the types of retirement accounts you have. For example, traditional IRAs and 401ks, withdrawals from these accounts are taxed as ordinary income. Roth IRAs, withdrawals from a Roth IRA are tax-free because you've already paid taxes on the contributions. Brokerage accounts. Capital gains taxes apply when you sell investments in taxable accounts. In addition to federal taxes, you'll also need to account for state taxes, if applicable, as well as your filing status and overall income bracket. It's a good idea to consult a CPA or financial planner to help you estimate your tax liability and develop a strategy for minimizing taxes in retirement. The bottom line, is $1 million enough? In summary, a $1 million portfolio can provide a decent income in retirement, but it may not afford the luxurious lifestyle that many people associate with millionaires. Based on a 4% withdrawal rate, You can expect to generate about $40,000 per year in income from a $1 million portfolio. When combined with the average Social Security benefit of $18,000 per year, your total annual income would be $58,000 for an individual or $76,000 for a couple before taxes. While this is a solid amount for many retirees, it's important to keep in mind that inflation, taxes, and market fluctuations can all affect the long-term sustainability of your portfolio. It's also essential to consider your personal lifestyle, health, and longevity when planning for retirement. $1 million is still a significant sum of money, but it's not the guaranteed ticket to wealth that it once was. As with any financial plan, it's important to be conservative in your projections and to adjust your expectations accordingly. If you found this video helpful, please give it a thumbs up and subscribe for more content on personal finance and investing.